Hi everyone, I'm so excited to meet with all of you today, my favorite people. I've been waiting for this moment for, I think, almost 2 weeks, and finally we're all here. And I want to mention that I adore my LinkedIn audience because you guys are so engaging usually, and I like your questions, I like your comments, and I hope that we'll receive a lot of questions today as well. And I'm an absolute awe to introduce you today to my guest, Christopher Orr, who has a very long list of accomplishments. And I really want to read it right now so that you have an idea how lucky we are today. Chris is an investor, entrepreneur, and advisor to multiple family offices, focusing on private investment, structuring, and partnerships. He served in the United States Air Force in technology and intelligence, both operationally and in research and development. He also founded his own companies in cybersecurity and technology consulting, and he's on several nonprofit boards, one of which is Operation Snow Leopard, which focuses on supporting the evacuation of Afghanistan refugees. He volunteers for environmental and social causes like the Unreasonable Group, an accelerator for environmental impact startups, the Cartier Women Initiative Awards, supporting female entrepreneurs, the Moonshot Awards, a grant program for impact entrepreneurs. And this is not it. He also has a lot of degrees, an MBA from the University of Maryland, public policy training from Harvard University, an asset management program at Wharton, and a public leadership program at University of San Francisco. Chris, thank you very much for joining me today.
Thank you for having me. Appreciate it.
So we are going to talk about top 3 mistakes when fundraising from family offices today, but I don't want to limit ourselves to just these 3 topics, these 3 mistakes. And I want to go through my list of questions and provide a lot of value to our audience today. I want to start with first that I scrolled through our audience and I was very impressed who is actually joining us today, that there is a lot of CEOs and founders of companies. There is also a lot of general partners of venture capital funds and a lot of angels. And also I found that there are some people who own family offices and also manage them. And I really want you to say hi to our audience and probably share some thoughts.
Yeah, so it's a pleasure chatting with everybody, especially chatting with you, and sharing different thoughts on family office landscape, investing in general, as well as the idea for our startups and for VCs, the idea of raising capital from family offices. Just really happy to share and talk through that dynamic, having sat on kind of both sides of the, or all sides of that table. So really looking forward to it.
Great. So our plan for the next 1 hour is this. First, I really want to go over my list of questions for the next half an hour, and then I will open it for our audience. And guys, you can send all these questions to the chat, and then we'll filter them out. I see that a lot of comments already. I would be super happy to know where are you from. I see someone from London, from Serbia, from Geneva, from India. So yeah, just send us where you're from. We will be happy to, say hi. Okay, great. And I really want to open this conversation with, talking about cultural code and asking where do you think most of the family offices in the Middle East invest? And I also had a conversation with one of my friends, and we were talking about that every single country has its own cultural code, and some people really like to invest in property, some really want to invest in real estate, in tech, some people really want to invest in some other things. And I even posted a poll on my LinkedIn, and I asked my audience, what is your definition of success? And I gave several variants. First was, I'm first investor in Grok. This is my definition of success. Or I own property at Soho. Or I own a vineyard in Italy. Or I met with Sheikh Tahnoun. And most of my audience voted, like 50% of them, I own a vineyard in Italy. And so my question to you is, how do you think, what is the priority for, let's say, Middle Eastern investors, family offices? Where do they invest mostly?
Yeah, well, I guess first, for just looking at the comment section and everybody saying where they're coming in from, it's super cool. This is my first time ever doing a LinkedIn Live, and honestly, I did it just because it's you, Genia. And it's just really cool seeing the engagement from all around the world. So that's really exciting, and getting to kind of chat with everybody. As for the idea of Middle Eastern family offices, I think the first kind of statement is kind of a broad brush statement that a lot of people sometimes overused, but if you've met one family office, you've met one family office, right? Every family office is incredibly different because by definition, it caters to the kind of needs of that family. So the idea of any group of sort of thing as being the exact same, probably not so much. The greatest example, I think, is whenever you have typically a banker, an investment manager, a fund manager talking to a family office and saying, this is what you should do. That's probably a little bit disingenuous, I think, on average, just because the idea that they don't even know that person yet, right? Does this family, have cash flow needs, right? Do they need to pay out a dividend to all of their family members because they're living off of that? Do they not have any of those needs? Is it, 50 family branch members, or is it 2? Right? All those type of things are things you kind of have to understand about the family first before saying that there's a reason or what they should do. Having said that, I think there is an idea where if you do, a lot of family offices in the Middle East are not going to invest into something that has interest rates, right? So something that has debt associated with it, unless it's, been blessed, so to speak, right? So a lot of things can be haram from that aspects. Whereas private equity, and venture capital and things like that, where they don't actually have interest being charged, right? There's usually a little bit more of kind of okay from that perspective. But that also does bring an interesting idea of property, right? Because property is one of the main places where lots of family offices typically hold a lot of capital. And so in that, right, there are certain families that are okay with it, certain families that aren't, but even the ones that aren't okay with it, they'll still invest in the property. They'll just buy the whole asset outright, right, and then use different type of models from that perspective. So I think in general, the concept of what families invest into from the Middle East, I think on average, I think one of the things to look at besides asset class is actually geography. So more Middle Eastern families actually do invest into, when they look at developed markets, they do look at Europe and they look at the US, primarily Western Europe and the US, as kind of a counterbalance from a risk perspective and growth perspective to their more local or regional markets. Sorry for that ramble.
I actually have the next question, which is probably following the previous, and it's about the ratio between private equity and venture capital. And I remember that we talked about that, and you said that there is no healthy ratio, or it's like yes and no. I really want to know a little bit more about that.
Yeah, so a friend actually ran a poll amongst a community of kind of family offices recently, and the poll basically said that it was the idea of how much do family offices allocate to different types of private equity, and the poll came back with 36% allocate towards early stage venture, and that was the dominant strategy. 22% went towards growth capital, and buyouts were about 20% in the mid-market side of the house. Secondaries were about 14%, and late-stage venture was about 11%. So it's interesting from a stats perspective on that, but it's actually a pretty large number of family offices that answer that poll. But at the same time, that those are, I would say, the people that are in that group are a little bit more biased towards venture just because of, you could just call it demographic, age, and a little bit more European focused. So I think there isn't necessarily a right fit, but I think that a lot of family offices that are new to setting up are trying to look at it from a perspective that it's like, what is my exact right ratio? And I'm not sure if that's necessarily the right way that families probably should be approaching it, right? If you have 10% venture, 20% venture, 30%, doesn't really matter. It's more a matter of what your strategy is long term. Are you a family that goes, this is generational wealth. I'm investing this for the next generation. And the time duration of when my capital comes back to me is actually less important. Or is it a matter of like, I need to have my capital back in 4 years, 5 years, 6 years? That itself leads to a completely different type of investment profile, let alone more do I like venture capital or like private equity? You could like venture capital all day long, but if you need your capital back in 6 to 7 years, you probably shouldn't be doing VC. So.
By the way, I'm just thinking right now, let's say if it's first generation, could it also be different from, let's say, fourth generation or eighth generation?
So it's a good point. I would say first or fourth is not so much the differentiating factor. It does differentiate a lot of the personality of the person who's trying to make decisions, and we can talk about that quite a bit for referencing some concepts of friends. But I would say it's more a matter of, do you think of it as, what am I doing? Or do you think of it from a perspective of like, what am I doing for my family in future generations? So I have friends that have moved to other parts of the world, and they've basically said, I'm now building up my family office for not only my kids, but their kids. And I'm thinking about that generational transfer of wealth and how do I support that? And I have other friends that literally say, I don't have kids. In the long run, probably all of my capital will be donated. Right. And so for them, they're just more a matter of like, what do I want to do today that I find interesting? Right. And funny enough, you'd imagine like those people would be just partying and having a good time, but they love business in general. So they're always looking at what they want to invest in, how they want to operate. Do they want to be an operator as an active person, or do they want to be a passive? And all that, I think, kind of becomes part of that discussion.
And so I was thinking that we'll also discuss what kind of problems usually family offices have. But let's say, have you had an idea, or let's say, have you had a request from someone who wants to diversify the portfolio? Like, for example, a family office out of Jeddah, in Riyadh, or like Saudi Arabia. Do they actually think about that at some point of their lifetime?
Absolutely. And I think all of those are so as an example, one friend, every time anybody in her family turns 16 years old, that person gives them $250,000 to be able to trade public markets. They want their next gens to better understand investments and business, and so they do that. I think there's a really great goal behind that, trying to get those next gens involved. Unfortunately, I don't personally think that ends up getting the outcome that they want. It makes a lot of 16-year-old gamblers, because a lot of them are still not really understanding the fundamentals behind the businesses they're investing in. They're just saying like, oh, I heard about, Elon, I'm going to go buy some, whatever. Right. So I think it doesn't quite get their accomplishments, but I really love the reasoning for that. But the concept of how they want to kind of do that and invest and get their family engaged, from whether it's Saudi, whether it's UAE, whether it's Singapore, I think the concept is trying to understand those international, both public markets and private markets, and figuring out, what's kind of interesting to the family. Right? So.
Yeah. So my next question is about success. I really want to talk about that. I remember that we agreed that you don't name names, but can you give the example without naming something and describing the success of family offices from the Middle East?
Yeah. So, I mean, success can definitely be that, like I'm an investor, or I own part of that vineyard, right? That's definitely an aspect of success. I think those type of things are great, and success can be that I have a friend who, he was a founder himself, right? So not originally from generational wealth, he created generational wealth, and he set this goal for himself, saying that when I get to this milestone, I'm going to buy myself a Lamborghini, because he set that goal. The funny part about it is, when he hit that goal, he actually didn't really care about the Lamborghini anymore. It wasn't really a big thing to him. But the thing that I thought was actually quite interesting is that he still bought it. He bought a used one, but like, he's actually very reasonable. But he bought a used one just because he's like, well, I set that goal. I shouldn't set goals and then not, give myself the reward afterwards. So he bought that Lamborghini, and he like never drives it. He doesn't care about it at all. It's not really his thing.
That's a very sad story.
Yeah, but it's kind of that. Well, he achieved other things that he didn't have his goals set on at that time, but that financial freedom, the ability to travel more and spend more time. I would say the most common thing in the Middle East that kind of um, is a sign of success is the idea of being able to take the summer off in the in Western Europe or the U.S., right, and kind of travel, escape the heat, but travel, right? And then the concept of some people take a month off in the winter to go ski in somewhere in the Alps or Japan or something like that. That type of flexibility in time, I think, is one of the biggest marks of success. And I would also say it's probably the most common in the Middle East that you can see consistently playing out. And that also kind of plays into, I think, one of the things that's happening in the Middle East right now as we're going through this transition of it being, for lack of better words, almost cool to have a family office. I think there's a different definitions of family offices, and every advisor, every banker will tell you, oh, well, you should be $100 million so you can have your own employees, so that way they can help you invest your capital, and that's the turning point of what makes sense. And that's great for those advisors that are trying to make money off of your AUM. But in reality, I think that what happens is that these families hire in a senior banker as their CIO, and they build out this staff, and then they go on vacation for 3 months at a time. And even when you hired that person in that was supposedly your CIO, they don't actually have the last final decision on a lot of investments. So now your very highly paid staff are kind of sitting on their thumbs for, a few months out of the year. And even though you can do certain things remotely, right, if the family is still going to be that final decision maker, that model I don't think is working the best. But a lot of families are going through those um, learning experiences, let's call it.
I want to start transitioning us from buy side to sell side. And my next question about what the situation, let's say, partnership with family offices, right? So what can go wrong when working with family offices on both sides, buy side and sell side?
Yeah, so I think the one thing that I would say to just anybody in general in life, right, is we all need more empathy. And that empathy aspect is trying to understand the perspective and the point of view of the people you're talking with. So what I tend to see from let's say, a startup founder, right, or a VC pitching a family office, everybody tends to look at it from the perspective of, you're wealthy, you're rich, you should invest into me. And 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 almost with that level of arrogance sometimes too. Whereas a matter of, like, what is that family even doing? Are they investing to directs? Are they investing to funds? Is this a thesis they even like? There's a difference between educating and, like, hard pitching them without really understanding what they're looking at. So I think that concept of understanding, for a startup to understand that VC's thesis, for a VC to understand that family office's thesis, right? For that startup founder to understand that family office's thesis. I think all those things are very important. And I think when engaging with family offices, when you see them just as, a dollar sign or real sign, right? Like, I think that's probably one of the biggest mistakes I see. And then the idea of thinking just because there's a large wealth aspect, then they can or should write a large check, right? Because those things don't always make sense, because there should be that aspect of how much of your capital is passive investments, managed smart portfolio, versus maybe I do have some set aside for direct investments, and maybe that is strategic to my family office and how we operate, because we have the ability to diligence and source and everything internally. Or maybe, for lack of better words, that's a little bit of my money that me as a patriarch or matriarch or next gen might be doing that a little bit for my own learning or my own fun. Right.
It's very interesting that you said, because let's say when working with VCs, I think that you actually can guess how much money they have in the fund, how much money they deployed, because, let's say they raised $20 million venture capital fund and they invested in, I don't know, 5 deals. You can kind of calculate how much money left, right? That's first. And second, the thesis is always on the website. How to identify the investment thesis of family office and the strategy.
Yeah, that's a great point. Some VCs don't list it, and it's more opaque, but for the most part, you're 100% right. And then you can check PitchBook a lot of times. You can see what they've invested in, and just understanding power law, you kind of understand what the size of their fund is, as long as they're even a remotely decent manager. Plenty of non-decent managers though too, so you never know. But on the family side, they're 99.9% of the time, right? It's like it's opaque. And that 0.1% of the time, it's usually a lie, so it's not real. For the website, when it says we're this many billion family office, yeah. But I think that goes to the other maybe aspect of it, is that I think with any family office aspect, you do need to actually build the relationships. I think you need to understand and actually have conversations, and it's not fast money, right? The concept of just trying to have a quick conversation, like you want to understand and get to know the family, and eventually it's I would also get to the point though, it doesn't really matter. Like, is the family a $1 billion family or a $100 million family? It's more a matter of what they're interested in writing or investing into you. Their size doesn't mean you try to convince them something different necessarily, right? It's more a matter of understanding what is the capital that they want to invest into that strategy or into that type of company or that sort of thing.
Yeah, that brought me actually to my next question, is that actually how to build this relationship, and also probably for startup founders, how to better pitch family office.
Yeah, I think there's also an aspect where unfortunately most startups are not going to meet a whole bunch of family offices all the time consistently. It just doesn't really kind of happen as much. But I think when you do meet family offices, they're just other people, right? And it's just having another conversation with other people and understanding what their goals are. I think with a startup, with any founder, me being one before as well, right? That concept of being super excited and wanting to tell everybody about what you're doing is wonderful. And that's kind of the passion you have in building that company. And that's fantastic. And there's always a place for that. But I think it's also starting off with questions. Ask people what they're interested in. If you're meeting a family, just happen to be, at an event or whatever else, and you're meeting and they say, oh yeah, I'm from a family office. That's great. What are you guys looking at? What do you guys find interesting right now? Why? Why is that asset class interesting? All those things I think are maybe a good place to start, right? If they say, oh, we only invest into private credit, and you're a startup doing, something on the tech AI side of the house, trying to hard pitch them after that probably doesn't really go over that well. Whereas if you say, oh, that's interesting. Why are you interested in private credit? Understanding that, that's great. Build an actual relationship, that you'd actually grab a coffee with them in the future. Then they might say, you're doing tech and AI? I have these other friends that might be interested in that, right? But then there's that actual like real warm referral, as opposed to the idea of, let me keep pitching my idea to you until you succumb to my amazing pitch, right? That never happens. So
Yeah, the next probably difficult thing for a lot of people to find contacts of people and how to find the right investors, right members of family office, because some people have LinkedIn, right? Sometimes you can find emails on the websites, but even me, when I was creating a post on women who are running family offices in the Middle East, I Googled a lot of princesses, but you will never find contacts, right? There is also such a problem. What is the best way to meet people?
yeah, there are family office conferences, there's events, and then there's just personal network, right? So I think and those conferences cost a lot of money to attend, and how much, if you're a startup and you're looking to raise money, what's the real ROI on that? I think it's really quite challenging to say that, because one is it's hard to get in the room with a lot of those different folks. So if you're paying a few $1,000s to attend, if you even get one investor, maybe it was worth it. But if you go to 5 or 6 events and you don't get any investor from that time, maybe that was a waste of all that money. So it's kind of a hard aspect, because it is a little bit more risk. And then if you go to 5 or 6 events and you don't raise any money, were they bad events? Was it bad attendees? Or maybe my pitch was bad, right? Maybe I didn't connect with them in the right way. Like all those things are these variables about, whether that matters. I personally think the warm introduction is probably a better way to go, and it takes time to do that. It's slow. In general, if you're a startup and you're raising from family office, if you're raising from VCs, if you're raising from anyone, I think you should always be bucketing about 6 months for capital raising. It's not a fast process, right? There's a lot of relationship building. There's a lot of due diligence on the other side. So I think that concept of thinking about it more from truly a relationship aspect and a long-term relationship aspect is probably a little bit healthier way to go. But once you do have those relationships and people know that you're trustworthy, you're doing something very interesting, even if they're not investing in you, maybe they're willing to introduce you to other people they know that might have that interest, right? But the concept of doing the cold call email out to family offices because of their website, I don't think tends to work so well, because most family offices in their teams don't really have that internal, they're not built like venture capital funds, right? They don't have this intake email where they're just vetting every single deck that comes in, right? So on average doesn't go that well from the cold outreach.
Yeah, I'm also thinking about, let's say, people from Europe or from United States. Probably they hear a lot of news about NEOM and other very cool projects in Saudi Arabia, and they also probably want to be a part of it. Do you know what would be the ideal scenario for like European family offices, how to support Vision 2030 in Saudi or UAE?
So I think in general, so if you're a European FO, right, and you want to be part of kind of the boom that's going on in the Middle East and especially in Saudi right now, I think the best way personally is to partner with other family offices in Saudi, right? The concept of when you're going into any other market, one of the strengths that a lot of family offices have is that they can build other relationships with other family offices a little bit easier than other people can, and partnering with other people that have that knowledge and expertise in region, right? Especially if you're essentially investing capital from afar, because I think that's always kind of beneficial to work with a partner that understands local laws, but more importantly, local relationships, right? It's helpful everywhere in the world, especially though in countries outside of the U.S., North America and Western Europe, right? The main difference is that in those countries, on average, not everybody, right, tends to be a little bit more transactional. But I don't mean that in a bad way. The reason they can be transactional is because you have historical represented rule of law that can enforce a legal contract. So I can find who's the best person to help me solve this problem, and let me, contract around that to work with that, right? Whereas you have good laws, you have good courts, and all sorts of stuff in other markets for sure. But when you can really rely on those relationships of a strong business partnership family to work with, that might be maybe a better way to go.
I think that brought us to my last question about different advisors who are connecting startups and family offices or GPs and LPs. What would be your best advice for this kind of people?
For advisors that are working with the
Like
GP.
makers between startups and family offices or GPs, LPs.
Yeah, so I think the concept of the advisors that are kind of matchmaking between GPs and LPs, or startups and investors, whether that be VCs and family offices, I think the concept is a matter of that actually kind of specifically fills into that need of that relationship, right? So exactly what I was just talking about, whether it's a European family office going into the Middle East, whether that is a startup that's trying to raise capital from a VC, a sovereign wealth fund, a family office, right? The idea that that startup can build those type of relationships doesn't really happen that often, right? Because that startup needs to be focused on building that startup, right? Operating that company, building that technology, operating that market. How much are they focused on knowing all the different family offices in a region, right? Or all the VCs in a region? That's not really something that they can really focus on, right? And those relationships really matter. So even them having their internal IR person, let's say, right? That internal IR person, are they really building up actual relationships with different people everywhere that will actually walk them in the door, talk with different people, and will those people actually meet with them because of that IR person? Maybe, probably not, right? Most of the time, the concept is a matter of one of the reasons why is that you work with those advisors is because those advisors are the ones that like maintain those relationships continuously, right? How much coffee or tea are you drinking with people? How many meals do you go out to people? That sort of stuff. So I think those relationships are really, really important.
Okay, great. I think that we're ready to get some questions from our audience, and I actually start.
Actually, I do have a few other things that I wanted to kind of just talk through a little bit. Just because as you brought up some of these questions, it made me think about a few different things. The concept of risk in families, I think there's also another aspect for the family offices that are on the call, and then also for the VCs as well, right? From a language perspective, that I think is kind of an understated risk for family offices. I've heard this question so many times. Like we kind of talked about this, like what should family office invest into? Should they invest in a PE or VC or whatever else? And then the secondary question that usually follows that is, what returns should they be getting? Well, if I can get them 12%, is that good enough? And it's always kind of a funny question for me because it's like, well, okay, 12%, but there's a risk-adjusted return. Okay, but they think that that's the entire answer. If I can get low risk 12%, is that better than 18% high risk? Sure, everybody will have a different perspective on that. But I think there's one risk that's underestimated is call risk, the idea of reinvestment risk. When you're looking at it and you are an investment manager at a bank, a fund, sovereign wealth fund, or something like that, right? You're investing all the time. You don't really care that your capital is sitting on the sideline at times because you are personally getting compensated because I invest into great things and they got good returns, and that's fine. But if I am investing into, let's just say, two different types of funds, I won't even name what type they are, but one fund that every 3 years, it's a 3-year fund, and one fund's a 10-year fund. Is it better to be in a 3-year fund or a 10-year fund? Most people would say, well, the 10-year fund is going to be higher risk, but it's going to be higher returns. So as long as the returns are good enough, it's better than that 3-year fund cycled over and over again, right? But in reality, what happens is that 3-year fund, you get your money back after 3 years. It might be 12 months, 18 months, 24 months before you're able to find another investment for not only the basis, but also the gains on that. So now you've sat there for 12 to 18 months with that money not actually growing, right? And so that 10-year fund maybe is actually worth it. Again, it depends on what the returns look like, right? But that concept is you didn't have to reinvest that at all at that same time. So I think families especially need to be considering that when they think about it from the perspective of like, oh, I don't like that lockup period. Yeah, but as long as that lockup period, the people that are investing for you, those managers, are properly aligned and incentivized with you, I think it's actually maybe a good thing for part of your portfolio. Not for everything, obviously, right? What's my cash flow needs? What's my cycling? I don't want my risk all in the same time frames because of, market fluctuations. All those things matter, right? But the concept of reinvestment risk and the idea of capital sitting on the sidelines is something that family offices have to consider a little bit more if they're professionalizing. I mean, if it's just a matter of like, we're having a little bit of fun here, that's fine. But if they're professionalizing, I think that's one thing that they really need to be thinking about. And the other things, especially because we have so many people signed in from all around the world, I think the other thing that family offices, one of the biggest mistakes I see is the idea of underestimating currency risk, right? Currency risk and political risk. So I was at a family office conference one time speaking on a panel in India, and a lot of the people in the room were friends, and we were just chatting about different things. And when I was on stage, we were talking about investments internationally, geopolitics globally. And one of the things I asked the entire audience is, how do you guys diversify? How do you guys, manage your risk? And one person said, well, we I actually had to push them because, nobody raises their hand at these conferences. So I still push them anyway. But I was like, no, seriously, I've talked with a lot of you guys on the side. So how do you guys manage your risk? And one person said, well, we don't just do property development in our state. We do property development in other states. And another person said, well, we don't just do property development. We also have an operational business. And another person's, whatever. And then I just asked, what happens if the rupee goes down? And the room was silent, right? Part of that is currency controls in India is super challenging in certain regards. There's certain ways, but that's challenging. But the concept is a matter of I was like, how many of you all send your kids to go study in the US or the UK? The whole room raised their hand, right? How many of you guys buy property in the US, UK when your kids are out there, or you travel there, right? And those are all things that they obviously all do, but now they just really hadn't thought about that, right? So in a given year, it can really, really hurt them when they need to take certain money out from that perspective. So that's one thing I think that currency aspect, but that call risk, I think is probably the greatest underestimated aspect of it too. Yeah. And then I think the last thing that I'd probably say from a family perspective is that globally right now, it's really cool to say you have a family office. And I think that's one of the reasons why a lot of people are setting up their family offices. But I think families really need to consider how active they really want to be. I do think that all high net worth families should have a family office, but how you build that and how you structure it, I think can be very different. The idea of having that big, lavish 10 to 20 person staff with big names and resumes behind it, I don't think fits the needs for 95% of families out there. Most of the time, it's a matter of how does that balance into your lifestyle when you actually take vacations, and how much do you really want to be an active manager? Anyway, that's my rant. So.
Maybe you can also share about your model, how you work with family offices.
Yeah. So I'm building out what I call an extended family office, and the concept is to work with other family offices. The play on words is basically like my cousins, right? My aunties, my uncles are part of my extended family. How do you work with your extended family? How do you work with other families that are more family aligned? But the concept of understanding the challenges that families have. So it's more focused on that aspect, but it's based on the idea that almost all my friends that have hired big staffs and built out their family offices, pretty much everybody regrets it just a few years later. So.
Okay, Chris, thank you very much. Let's move to our questions, because I see it's like more and more and more, and I really want to give the opportunity to people to also to engage. And so, is it any trend in family offices? I don't know if there is.
I think the trend is the idea of setting up family offices. That there's, I don't mean it in jest. The concept of the number of people that are setting up family offices is incredible. This was a term that wasn't even really understood or known a few years back. The idea of having staff internally to help you invest your resources is a different concept. There's also the idea of family offices, and the term family office gets used in many different ways. Somebody that has a driver, a helper at home. In Southeast Asia, we say helper when they're like a nanny or something like that. Your plane, your captain for your boat, right? Your dog walker at any different level, right? All these people are people that you might fully employ yourself, or on a contract basis you employ, and all of that might be managed by the family office. So sometimes that is just paying the staff and managing staff, and it could be those aspects, or it could be a matter of your internal investment team doing investments. But I think a lot of people, I had a friend recently actually just say that where the family is a multi-billion-dollar family in the US, and they were literally like, yeah, we feel like we have to have a family office now. Like they never had a family office, so to speak, but they felt like they have to have a family office now, because like, how can we be, a really successful family if we don't have a family office? And it's kind of hilarious. The idea of what a family office is, and then the separation from a family foundation versus a family holding company versus the family operating company, and figuring out how all that fits in. I would say there's no exact right fit, kind of depends on the family, But yeah, it's pretty interesting for that trend.
I have your favorite question here. Do you believe that LinkedIn cold outreach could be efficient for LP lead generation?
So I think any way that you can start a conversation is a good first step. I think the idea of building real relationship is the important part about that, though. So the cold outreach might be the first way you meet somebody, right? But then you do have to actually build a connection there and build a relationship there. That relationship, I don't mean anything more than you actually wanting to talk to that person, right? That person actually wanting to talk to you, help you, whatever else. So, as a for instance, right, I was just at a family office conference in New York last week, and when I was there, I'm very happy to talk to people that are families, that are service providers, that are fund managers, that are startups, that are whatever. And the way I look at any of these conferences is if I meet even one person that I'd actually grab a coffee with in the future, that's kind of a win. You meet a lot of people that are hard pushing and hard selling and like shoving their business card into your hand, right? And they don't even ask a question. They specifically start pitching to you, this is what we do, this is why we're so amazing. By the way, do you have money? That's the only question they ask. And that's typically doesn't go so well to build relationship, right? But instead, if it's a matter of like, hey, I'm reaching out, I've had people reach out to me on LinkedIn and I've answered plenty of cold outreaches, but it's usually a matter of, hey, I'm a junior or senior in college. I'm thinking about what I want to do now. I was wondering to know, I saw your profile and I read through it, and I was wondering if you have any advice on this, right? Those type of things are like meaningful because one, I'm always happy to help somebody if I can, right? But it's actually like they took the time to understand that I do have an expertise in a specific area and they have a very specific question, as opposed to the cold outreach of, hey, can you introduce me to wealthy people? Yeah, right,
Doesn't work. Yeah.
right, across the board. So I think cold outreach is great, and I think that's one of the ways that people should do things. But the concept is a matter of don't do it from a cold outreach from the concept of like, I just friended you, and by the way, here's my deck. Please read through it, and hopefully you'll invest. Right? That's probably doesn't go so well. Like I'd be surprised if that goes really well for them. But yeah.
Yeah, so I really like this question because we started the conversation about that, about different variants, how to find connections, like with the family offices, but maybe there is some other specific networks, platforms, indirect strategies.
There are family office conferences. They cost a lot, so I'm not. And the conferences that I attend and the organizers love them to death. I think they're great people and they bring together really great groups. Like, is it like, am I hard recommending that everybody should attend these? They're expensive, right? So I think you have to make your own ROI sort of process and thought across that. But there are few ways to be in the room with so many people that all have the ability to allocate. Again, is your company, is your fund, is that the right thesis? All those are different questions, but you're in the room with, hundreds of people that have the financial ability to. So at least there's that kind of initial kind of check. So I think those are one way to do it. And I have friends that have had great success in that. And then I think other ways, there's this funny, okay, for some of the people I know, I'm not sure how many people know this brand called Cutco. It's a kitchen knife company, and it was my first, not my first, it was one of my jobs in college between summers. When I came back from boot camp from the Air Force, I went and sold kitchen knives, and it's the funniest sort of job, and I loved it. I was such a young, eager kid that I was like, these knives are great. It was so easy for me to sell these knives because I was super enthusiastic about it. It's kind of an embarrassing story here when we're talking about family office and selling kitchen knives. But the reason I bring it up is one of the things that they always talk about, and this is just sales 101, right? Or relationship building, CRM 101, right? Is anytime you're talking to somebody and they actually have a good feeling about you, they like you, maybe still don't even like your product, maybe still don't even like, like that's not the asset class for them, but you can still ask them afterwards, by the way, is there anybody else you think I should talk to? Right. And I think that concept of building rapport with somebody first, and then later on after asking if there's other people that they recommend, it's amazing how many people will kind of say, you know what, you should talk to this person and this person. Oh, and that other thing you should talk to this person. If that one person introduces you to one or two or three other people, like that's kind of the win, right? Is it a matter of like, oh, I'm there in front of 100 people and 99 are gonna, go? It's not really. But like, I think that concept of, I love that comment. They are great knives and practically sell themselves. Okay, I like you. But yeah. So, but that concept of that sales strategy, right, where you're actually asking for referrals, I think is great.
I actually thought that you will probably share a little bit different story. So one of my friends, he started not selling knives, but selling horses. And right now he's raising checks to his VC from the same people who he was selling horses to.
So I actually know somebody that specifically bought a horse and got into the horse community because they wanted to be around people that could have horses. I know people in the film community, similar things and also stuff. I don't think that's necessarily a good approach. I would say if it's genuine, yeah, that's your network and that's wonderful, right? I wouldn't go out and buy a horse for that. If you love horses though, that's wonderful. And it is a community, right? And same with film and same with other things, but people can, not everybody, a lot of people can figure out genuine versus not genuine pretty quick, right? So if you're doing the car club sort of stuff just because you want to be around rich people that have Lamborghinis, that's one thing. Or if it's a matter of like you're a gearhead and you really love those cars yourself, right? That's passion, right? And that's community, and that's the people that become your part of your network. So I think all those things are reasonable considerations.
Yeah. So I picked up this question because Nick worked for me in my company, Multiplies. And right now he's working for another company, but I really like his question. And it's about digital assets. So he is the founder of a startup in Web3 world right now. And he's asking about the trends if family offices buy digital assets.
Yeah. So the digital assets things have been going on for quite a while, as everybody knows, right? Over a decade almost. Well, actually over a decade. I remember back in like 2016 when the big sale push to family offices on digital assets specifically was the idea that they were an uncorrelated asset, right? So the concept of if you just hold a little bit of Bitcoin in your overall portfolio or other tokens, right, in your overall portfolio, right, now you can actually have a better Sharpe ratio and, to correlate your alpha. So that no longer exists. Now crypto in general, right, is a highly correlated asset, but it has, so if the public markets go up by 1, crypto might go up by 4. But if the public markets go down by 1, crypto goes down by 4. So it becomes a highly correlated asset, but it becomes an asset that actually gets, a greater alpha. So should it be part of your portfolio? The same way that like if somebody goes to their financial advisor and they says, what's your blend of stocks versus bonds? They say, well, my risk profile is this, right? How much do I, put into, small cap, so mutual funds? Well, you say, well, the spread on, risk can be up this and down this. Crypto to me just becomes another one of those type of things, right? So the idea that if I'm looking at it as a quote unquote asset class, I have to understand how high risk it is. And so I put it into part of my portfolio as part of my allocation, understanding that it's a very high risk aspect of that portfolio. And I think that part of that question was the idea of should family offices go direct into crypto itself? Should it go into the startups that are in Web3? Or should it go into VC funds that invest into Web3 companies? Or should it go into hedge funds and invest into crypto assets? I think all are reasonable depending on the family. Personally, I like hedge strategies quite a lot, active hedge strategies in crypto. The main reason why I like that is because of that volatility. There's so much volatility in crypto, and that's on average, what hedge funds kind of take advantage of is kind of trying to do that, take advantage of that type of volatility. I think the idea of VCs are always great. The concept of if a family should be investing into direct companies, I always caution that they should do it cautiously, right? With the idea of how much am I investing into this? How much am I risking of my personal capital? If it's one of those things where like, I really believe in this, right? That's great, but are they able to diligence it? So if the family's able to diligence the deal, right? And they have that expertise. Like I have a friend in Hong Kong. He does all the Web3 investment for his family. He runs, and a lot of his family's capital is in Web3, but that is his expertise, right? He knows that space inside and out, and so he can diligence it, and he can do both VCs, hedge funds, as well as directs, whereas the average family doesn't necessarily have that capability built in.
I really like this question. Investments in VC being strategically high risk, true. Do you see change in family offices' behavior by considering more direct investments? And if so, how? Yes, and there is another question about AI. I also see that there is a lot of other questions also about AI.
Yeah, so I should answer this question that you just asked before, because I see the chats talking about golf courses, and that cracked me up.
Yes.
I'll talk about golf courses in a second. But so VCs being statistically high risk, that to me, that's a leading question, and I don't agree with the premise. I think that if you don't know how to diligence VC as well, probably stay away from the asset class unless you have advisors that can help you with that aspect. VCs are the highest returning asset class, and they can also, you can do venture investing incredibly high risk, or you can do venture investing at a much lower risk. But does that much lower risk get the type of returns you want by investing into venture? Case example is, do you want to invest directly into individual companies at $5 million a check each? Maybe not. If you're a billionaire, $5 million, maybe that doesn't matter. But if you have $100 million, that's probably ridiculous, right? If you, should you be investing into funds? Yeah, probably. Should you invest into one fund? One fund that's only in one city, that's only in one vertical? That's still reducing your risk. I mean, that's still reducing your risk from one company, but maybe it's still all consumer tech focused VC. Or should you be in a consumer tech VC as well as another fintech VC, as well as another biotech VC? Or should you be invested into the VCs that are more, forgive the term, spray and pray? They invest all across every market in early stage companies, anything that comes to them. All these are different models. I think the idea that should any family office have some allocation to venture capital, I think personally, yes. Should that percent be 1% or 60%? That's depending on the family. But I think that there's some allocation, but I'm not thinking of it as venture capital. Well, I am, I guess. I'm thinking of it as higher return asset class and a longer time duration of investment, right? So some should be allocated there, right? But the idea is that that allocation in my mind should either be to funds or fund of funds, not into as many direct companies, unless that family has the ability to diligence it internally.
Do you want to choose the next questions yourself?
The golf course one, I thought that was hilarious. So
Yes.
somebody said like, should I get into golf for that?
Yeah,
golf and tennis are interesting. Pickleball now has become a really big thing for a lot of people. The interesting thing about golf is that if you do go on the golf course and you play with somebody, you're with them for 4.5 hours, right? And you're, having conversations with them during that whole time. So I think that becomes kind of funny from that perspective. The one challenge with golf, though, is that there's very different skill levels, right? So with the different skill levels, if you're trying to woo a family office and that person's a scratch golfer and you hit things, into the water every hole, maybe not the right sport for you to be, trying to do your business development, right? Or relationship building. That's actually why I brought up pickleball. And I see this kind of creates like my mom teaches pickleball, helps at a senior center, like teaching pickleball. She plays in like pickleball tournaments. So I go out and play with her and stuff like that at times. I'm really close with my mother, right? And so the funny part about pickleball though is you can have different levels, you can have different skills, and you can still go out and play and just have a fun time and have a conversation. So I think from the kind of social sort of engagement and enjoyment sort of aspect and be able to have a conversation because you're so close to each other, pickleball kind of works a little bit better. Tennis is like you're further away, you're not really having a conversation while you're playing. So just throwing that out there is kind of a funny sort of concept from that perspective. I like the comment about career-long relationships through golf, and I think that's great, Richard. And I think that comment though, I guess I would say that most of the people you've golfed with are usually within closer band range of skill set, right? Like not wildly different, right? Like you don't have to be as good as the person you're playing with. I do like golf tournaments when they're best ball. So best ball, I think paddle is that kind of concept with you do have to have a similar talent level when you're playing with on paddle, right? Because it's very athletic, right? You actually have to be able to play kind of like racquetball or squash, right? Like if you play against somebody that's like really bad and you're pretty solid, right? It's not as fun. So.
Yeah, I see the question that I also want us to answer. About regrets to set up family office. I think that could be interesting.
Yeah. So the one I've seen the most is like, I hired this senior banker as my CIO, and then we hired these 2 to 3 analysts in this asset class, these 2 to 3 in this asset class, these 2 to 3 in this asset class. And then, we have eventually this 15 to 20 person staff, all this investment. And then the family's really not ready to do that, right? They're told that that's what they should do because they're a billionaire family, but the idea that they have that ability to really run that internal team, right, is not necessarily really the case. And here's the funniest part about it, in my opinion, at least. Sometimes you do have that family member that is that, they were an investment manager themselves before externally, and now they've come back into the family and are trying to run that internally for the family. Even when you have that situation, what about the next generation? I think families need to always be asking themselves that question. What about the next generation? Right? And that's the difference. That's the one defining value between, quote unquote, the way we would categorize an ultra high net worth individual versus a family office. The family office is always thinking about the next gens. How do we encourage our next gens to get involved is one thing, but how do we make a structure and a concept that allows next gens to not get involved if they don't want to? I have a friend that is, her and her brother are both in the arts. Their family is one of the largest fastener manufacturer in the world. Fasteners are nails and screws, the most boring thing possible, but it's like industrial. The sexiest thing about their business is their spreadsheets. Makes lots of money, churns out lots of capital, and that's great. But neither of the next gens really want to operate that. So what does that mean? What does that do, right? Does that mean, oh, well, you should really have a family office with 20 staff to actually see that as one of your investment assets? You could think about it that way, but they're again in the arts. They don't even want to be in the investment side on the family office. They want to be a shareholder. They want to receive the dividends. But I think that concept of that regret is setting up the family office too big, too fast, too whatever, and hiring the senior people early is probably not the way you want to go. I think family offices, the way they should start, you can always grow bigger from this, but I think the way family offices should start is they should start with a couple junior people that they can call at any hour of the day and night and work with as kind of their team, right? But they should really work with a few different advisors that are external, put those advisors on retainer, and then that way you can have that conversation at any time and have those advisors separate from each other. So that way you get different points of view from different parts of the world with different asset classes. Unfortunately, I know family offices that when they have their whole senior team internally, the internal team actually stole from the family, right? And that's one of those things you want to also protect from, right? So, yeah. Anyway.
Yeah. We actually have 1 minute left, but I really want to cover this question very fast. I think that it comes from the founder who is trying to understand what are the gaps in the education of family offices, and maybe he's trying to create a product for that.
So from education, are there initiatives being undertaken to educate? So I would say a lot in Asia are doing this, both in Singapore and Hong Kong. There's lots of government programs, university programs. One of my friends runs Chinese University Hong Kong's like family office program to basically help the family office executives, employees that want to work for family offices get education around that space. I haven't seen any formal programs in the Middle East from a government perspective or doing that yet as much. Yeah, and I think just the really quick last little bit in family offices, there's a hiring for competency and skill set. There's a hiring for trust. I would say trust is the most important. We say that in the military as well. In the SEALs, you'd rather have somebody that's really trustworthy and good versus somebody that's not trustworthy and excellent. So you really need trust inside the family office aspect. And I think people need to build for that. Unfortunately, some people are hiring for title. Like, so, oh, we want that person who's an MD at this bank or whatever else. And I think that's almost like the worst way to hire because that almost never pans out well. So anyway.
Great. Chris, thank you so much for this webinar. We have so lot of questions left. I don't know what to do with it. I think that we have to discuss how to answer all of them, probably in writing.
We can do a follow-up call sometime. Always happy
Maybe.
to. This was fun. So thanks.
Yeah, it was really very fun. Thank you, everyone. You, like always, I enjoy talking to you. And then all of my speakers are very happy to, join me during these webinars. And yeah, let's see, maybe in a couple of weeks we can do a follow-up call.
Sounds great.
Yes.
Thank you so much.
Yes. Have a good day, everyone.
Thanks, everyone, for the questions.